Welcome back. Welcome back, everyone. I hope you all had a great week. In our previous lectures, we explored the basics of the conceptual framework for financial reporting and delved into its historical development. Today, we will move forward with our syllabus and begin discussing the first chapter, the objective of general-purpose financial reporting. Syllabus overview. Here's a brief overview of the contents we will cover in this chapter. 1. The objective of general-purpose financial reporting. Introduction. Objective, usefulness, and limitations of general-purpose financial reporting. Information about a reporting entity's economic resources, claims against the entity, and changes in resources and claims. Economic resources and claims. Changes in economic resources and claims. Financial performance reflected by accrual accounting. Financial performance reflected by past cash flows. Changes in economic resources and claims not resulting from financial performance. Information about the use of the entity's economic resources. Introduction. The objective of general-purpose financial reporting forms the foundation of the conceptual framework. Other aspects of the conceptual framework, the qualitative characteristics of, and the cost constraint on, useful financial information, a reporting entity concept, elements of financial statements, recognition and derecognition, measurement, presentation, and disclosure, flow logically from the objective. Detailed explanation of the introduction. Let's break this down to ensure we understand it thoroughly. 1. Objective of general-purpose financial reporting. This is the cornerstone of the conceptual framework. It defines why we create financial reports in the first place. The primary objective is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. 2. Flow of the conceptual framework. The objective influences all other aspects of the conceptual framework. For example, qualitative characteristics. These are the attributes that make the financial information useful. They include relevance, faithful representation, comparability, verifiability, timeliness, and understandability. Cost constraint. This concept acknowledges that while providing useful financial information is important, it must also be done cost-effectively. Reporting entity concept defines what constitutes the entity for which financial information is provided. Elements of financial statements includes assets, liabilities, equity, income, and expenses. Recognition and derecognition concerns the criteria for including or excluding items in the financial statements. Measurement refers to the basis on which financial elements are quantified. Presentation and disclosure relates to how information is displayed and the details provided to users. Example for better understanding. Imagine you are an investor considering whether to buy shares in a company. You would need comprehensive and reliable financial information to make an informed decision. The company's financial statements provide this information, reflecting the company's economic resources, assets, claims against those resources, liabilities and equity, and changes in those resources and claims over time. For instance, suppose the financial statements show a significant increase in the company's revenue over the past year. This information can be crucial for your decision-making process. However, this revenue data must be relevant, related to your decision-making needs, faithfully represented, accurate and complete, comparable, consistent with other companies, and timely, current enough to be useful. Conclusion. Understanding the objective of general-purpose financial reporting is essential because it sets the stage for all other elements of the conceptual framework. By ensuring that financial reports meet these objectives, we can provide valuable information that aids investors, lenders, and other stakeholders in making informed decisions. Objective, usefulness, and limitations of general-purpose financial reporting. This topic is crucial as it dives deeper into why financial reporting is essential and the factors that influence its effectiveness. Objective, usefulness, and limitations of general-purpose financial reporting. Objective. The primary objective of general-purpose financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors. This information helps them make informed decisions regarding providing resources to the entity. These decisions include 1. Buying, selling, or holding equity and debt instruments. Investors need to decide whether to buy, sell, or hold shares or bonds based on the financial health and performance of the entity. 2. Providing or settling loans and other forms of credit. Lenders need to assess the entity's ability to repay loans or settle other forms of credit. 3. Exercising rights to vote on or influence management's actions. Investors may use financial information to decide how to vote on management decisions that affect the entity's economic resources. Example: imagine an investor considering buying shares in Company X. The investor will review Company X's financial reports to understand its profitability, debt levels, and cash flow. This information helps the investor decide whether Company X is a good investment. Usefulness. To be useful, financial information must help existing and potential investors, lenders, and other creditors assess. 1. Returns expectations. This involves understanding the amount, timing, and uncertainty of future net cash inflows, such as dividends, interest payments, or market price increases. 2. Management stewardship. This assesses how efficiently and effectively the management has used the entity's economic resources. Example: consider a lender evaluating a loan application from Company Y. The lender will look at Company Y's financial statements to assess its ability to generate enough cash flow to repay the loan. Additionally, the lender will evaluate how well the management has managed Company Y's resources in the past to predict future performance. Information needed for assessments. To make these assessments, users need information about 1. Economic resources and claims. This includes details about the entity's assets, liabilities, and equity, and how these have changed over time. 2. Management's efficiency and effectiveness. This involves evaluating how well management has discharged their responsibilities in using the entity's economic resources. Example: suppose an investor is looking at Company Z. The investor will review the balance sheet to see the economic resources, assets, and claims against those resources, liabilities, and equity. They will also examine the income statement to assess how efficiently and effectively the management has generated profits. Limitations. General-purpose financial reports have limitations. They cannot provide all the information users need and must be supplemented with other sources, such as 1. General economic conditions and expectations. The broader economic environment impacts the entity's performance. 2. Political events and climate. Political stability or instability can influence the entity's operations. 3. Industry and company outlooks. Industry trends and company-specific factors also play a role. Example: an investor considering Company A must not only look at its financial reports, but also consider the current economic conditions, such as inflation rates and industry trends, which could affect Company A's future performance. Not a valuation tool. General-purpose financial reports are not designed to show the exact value of a reporting entity. Instead, they provide information to help users estimate the entity's value. Example: an investor cannot determine the exact market value of Company B solely from its financial reports. However, the reports provide essential data, such as revenue, expenses, and cash flows, which the investor can use to estimate the company's value. Primary users. Primary users of general-purpose financial reports include existing and potential investors, lenders, and other creditors who cannot obtain financial information directly from the entity. Management, although interested, can obtain internal financial information and does not rely solely on these reports. Example: shareholders of Company C rely on general-purpose financial reports to make decisions as they do not have direct access to the company's internal financial data. Management, on the other hand, can access detailed internal reports for decision-making. Estimates, judgments, and models. Financial reports are often based on estimates, judgments, and models rather than exact figures. The conceptual framework establishes the concepts underlying these estimates and judgments, guiding the preparation of useful financial information. Example: depreciation expense in Company D's financial statements is based on estimates of the useful life and residual value of its assets. These estimates require management judgment and are guided by the conceptual framework principles. Conclusion: understanding the objective, usefulness, and limitations of general-purpose financial reporting is essential for interpreting financial statements. While these reports provide valuable information, they are not exhaustive and must be considered alongside other relevant factors. Information about a reporting entity's economic resources, claims against the entity, and changes in resources and claims. This topic is crucial as it helps users understand the financial position and performance of an entity. Information about a reporting entity's economic resources, claims against the entity, and changes in resources and claims. 1. Economic resources and claims. Explanation: information about the nature and amounts of a reporting entity's economic resources, assets, and claims, liabilities, and equity helps users identify the entity's financial strengths and weaknesses. This information is crucial for assessing liquidity, ability to meet short-term obligations, and solvency, ability to meet long-term obligations. It also helps users understand the entity's need for additional financing and its likelihood of obtaining that financing. Additionally, this information aids in assessing management stewardship of the entity's economic resources. Example: imagine a company with significant accounts receivable, economic resources, and a large amount of short-term debt, claims. The accounts receivable represent future cash inflows, indicating potential liquidity. However, the short-term debt signifies immediate cash outflows, impacting the company's solvency. Users can assess whether the company can meet its obligations without additional financing. 2. Changes in economic resources and claims. Explanation: changes in a reporting entity's economic resources and claims result from its financial performance and other events or transactions, such as issuing debt or equity instruments. Users need to distinguish between changes resulting from financial performance and those from other events to assess future cash inflows and management stewardship effectively. Example: if a company issues new shares, equity instruments, this increases its equity without reflecting financial performance. Conversely, an increase in retained earnings from profitable operations reflects the company's financial performance. Users need both types of information to understand the entity's overall financial position and performance. 3. Financial performance, reflected by accrual accounting. Explanation: accrual accounting records the effects of transactions and events in the periods in which they occur, regardless of cash flows. This approach provides a more accurate basis for assessing an entity's past and future performance by showing changes in economic resources and claims during a period. Example: consider a company that makes a large sale in December but receives payment in January. Accrual accounting recognizes the revenue in December when the sale occurred, providing a better picture of the company's performance in that period. This information helps users assess the company's ability to generate future net cash inflows. Lesson 4. Financial performance reflected by past cash flows. Explanation: information about past cash flows helps users assess an entity's ability to generate future net cash inflows and management stewardship. This information shows how the entity obtains and spends cash, including borrowing, repaying debt, and distributing dividends. Example: reviewing a company's cash flow statement, users can see that it has generated significant cash from operations, but also has high debt repayments. This indicates that while the company is generating cash, it is also using a substantial portion to service debt, affecting its liquidity and solvency. 5. Changes in economic resources and claims not resulting from financial performance. Explanation: Changes in economic resources and claims can also result from events other than financial performance, such as issuing debt or equity instruments. This information is necessary for a complete understanding of the changes in the entity's financial position and their implications for future performance. Example: a company might issue new bonds, increasing its liabilities, claims, without affecting its financial performance. Users need to understand this to accurately assess the company's future financial performance and its ability to meet new debt obligations. Conclusion: understanding the information about a reporting entity's economic resources, claims against the entity, and changes in resources and claims is vital for making informed decisions. This information helps users assess the entity's financial strengths and weaknesses, predict future cash flows, and evaluate management stewardship. Today, we will discuss the final topic of Chapter 1, information about use of the entity's economic resources. Information about use of the entity's economic resources. Explanation: information about how efficiently and effectively the reporting entity's management has discharged its responsibilities in using the entity's economic resources is crucial. This information helps users assess management stewardship and predict future performance. Efficient and effective use of resources indicates competent management, which is vital for the entity's prospects for future net cash inflows. Examples of management's responsibilities. 1. Protecting resources from unfavorable effects. Economic factors. Management must safeguard the entity's resources from adverse economic factors, such as price fluctuations and technological changes. For example, if a company is in the technology sector, management must stay ahead of technological advancements to avoid obsolescence. Example: consider a smartphone manufacturer that regularly invests in research and development, R&D, to stay updated with the latest technology trends. By doing so, the company protects its market share and ensures its products remain competitive. 2. Compliance with laws, regulations, and contractual provisions. Legal and regulatory compliance. Management must ensure the entity complies with all applicable laws and regulations. Non-compliance can result in fines, legal battles, and damage to the entity's reputation. Example: a pharmaceutical company must comply with stringent regulatory standards for drug safety. By maintaining compliance, the company avoids legal issues and potential recalls, which can be costly and damage its reputation. Contractual compliance. Management must also ensure the entity meets its contractual obligations to avoid breaches that could lead to penalties or loss of business relationships. Example: a construction company has a contract to complete a project within a specified time frame. By managing resources effectively and adhering to the timeline, the company fulfills its contractual obligations, ensuring client satisfaction and future business opportunities. Predicting future efficiency and effectiveness. Evaluating how management has used the entity's resources in the past provides insights into their capability to manage resources in the future. If management has demonstrated a track record of efficiently and effectively using resources, it increases confidence in their ability to continue doing so, which is crucial for assessing the entity's prospects for future net cash inflows. Example: let's consider a retail company that has consistently increased its inventory turnover rate over the past few years. This indicates that management has been effectively managing inventory levels, reducing holding costs, and ensuring products are sold before becoming obsolete. Such efficiency can be a strong indicator of management's ability to sustain or even improve performance in the future. Conclusion. Understanding how management uses the entity's economic resources is vital for assessing their stewardship and predicting future performance. This information helps users make informed decisions about providing resources to the entity. Chapter 1: General Purpose Financial Reporting. In this chapter, we have explored the fundamental concepts of general purpose financial reporting. We began by understanding the objective, which is to provide useful financial information to investors, lenders, and creditors. This information helps them make informed decisions about providing resources to the entity, such as buying securities or extending credit. We discussed the importance of financial reports in providing information about a reporting entity's economic resources, claims against the entity, and changes in these resources and claims. This information helps users assess the entity's financial position, performance, and management's stewardship of resources. We also highlighted the role of accrual accounting in providing a more accurate depiction of financial performance over cash-based accounting. Furthermore, we examined how financial reports are not only tools for decision-making, but also have limitations. Users must supplement financial reports with other sources, such as economic conditions and industry outlooks, to gain a comprehensive understanding. Lastly, we explored how information about the use of the entity's economic resources helps users evaluate management's effectiveness and predict future cash flows. Management's responsibilities include protecting resources from economic factors and ensuring compliance with laws and regulations. Support and engagement. Thank you for joining us in this lecture. Your understanding of these concepts is crucial for navigating the complexities of financial reporting. If you found this lecture valuable, please consider subscribing to our channel and liking this video. Your support motivates us to continue delivering high-quality educational content. We look forward to seeing you in our next lecture, where we will delve into Chapter 2. Until then, continue to explore and engage with the material. Goodbye, and see you soon. Thank you once again for your participation. Have a great day, and see you next time.